Hello, everyone. I'm Ben Jackson with the IPA. We're going to give folks a minute here to get signed in, and then we will get started with the presentation. So bear with us here. All right, looking at the participant list, I see some of my good friends from the association are in, so let's go ahead and get started. Again, I'm Ben Jackson. I'm the Chief Operating Officer of the IPA, and I want to thank everyone for joining us today. At the outset, let me take care of a couple of housekeeping items. The first is that we are recording this, so if you have colleagues or others who you think would benefit from this discussion, be on the lookout for a link to the recording, and you can share this session with them, although it certainly won't be as fun for them as it would be to be here live. Secondly, I want to just take a moment and note that we have our compliance boot camp next week. We're going to be covering a number of topics, including money services businesses, chartering, building compliance into business models, and working with third parties. So if you haven't seen that, go to ipa.org and look at our calendar and check that out. And then finally, I want to, before I introduce our panel, answer one other question. The books indeed behind me are real. And I want to use that to say that the IPA is looking into starting a book club where we will gather folks together to read books that are sort of innovation adjacent, things that are adjacent to the payments industry that might help us do our jobs better. So be on the lookout for announcements around that. Now, I am excited about this panel, and I'm glad that I get to do this because all of the folks here I have done podcasts with, and I have talked about the different topics that we are going to go over in depth, and in addition, we've gone on some of the side things. So I encourage you all to check out our podcast page on ipa.org for those. But I know based on that this is going to be a really good panel. And I've got 3 different companies here that look at data at different points in the life cycle, but also look at data across entire operations. And so today I'm joined by Lindsay Davis, who is the head of markets, and Dumitru Mitaru, who's a software engineer with Atomic Financial. They're going to kick us off, and we're going to talk about sort of bringing customers in and understanding who we're bringing on and who we're dealing with. And then I have Adwait Joshi. He is the founder and chief seer, and we'll talk about what that means, of DataSeers. And he's going to talk about looking at your portfolio and what's happening inside and what kinds of things you can learn just from the behavior of your own customers. And then finally, I have Scott Edington, who is the CEO of Deep Labs. And Deep Labs brings a contextual view to data and the portfolio and things that are happening. And so kind of looking at what does the broader environment tell you about the things that you're seeing. And so let's jump in here, moving right to our topics and talk. And Lindsay, I'm going to start with you and talk about preventing fraud at the beginning and doing that through identifying the people who want to use a product. And so when you think about the companies that you work with and implementing KYC and knowing who you're dealing with, what do you guys do that kind of goes beyond those 4 regulatory basics, right? It's name, date of birth, taxpayer ID, and address. And then what trends are you seeing in the world around things like stolen ID and synthetic fraud?
Yeah, so broadly, I think it'd be important to set the stage. What is Atomic? What do we do? So we're building payroll connectivity, which is the infrastructure to connect consumers to the financial data in their payroll accounts, as well as to switch and set up payments with their direct deposits. We do this for some of the largest neobanks in the country, as well as financial institutions. But at the data level, when you talk about KYC and the ability to use payroll connectivity, we're helping financial institutions verify that the applicant and the applicant information is accurate against a payroll system versus today, which might be done physically on a piece of paper, which is subject to and prone to fraud, as well as other vulnerabilities such as the consumer being hacked if their credentials are leaked. And I wanted to hop over to talk about a specific feature that we've built out for this use case, in particular for a neobank that we're working with today.
Yeah, so this effort was first born when one of our customers, a top 10 neobank, came to us with an issue that they weren't seeing enough funding from the users that would use Atomic to switch the direct deposit into their account. And after manually digging through the data, what we found was that they had multiple users all trying to access the same payroll provider with the exact same set of credentials, the same username and password. And this raised a bit of a red flag for us because, of the obvious, implications. Our customer also offered an incentive to their users to switch to the direct deposit, switch your direct deposit to our account and get $20. And so the thought was that, an individual would create multiple user accounts on our customer system and then hop between these accounts with the same set of payroll provider credentials and collect this incentive each time. And so this kind of highlighted that we're in this unique position with this payroll connectivity data to start to recognize these patterns and to put a stop to this, and also give this data back to our customer. And so this motivated us to build out this our fraud first iteration of a fraud detection feature, in which we would go through and start to track which users tried to access which payroll provider with which username. And it's important to note that the username that they provide, we store a salted one-way hash of it, and so we're not using any sensitive information. We're not storing any of that. Also not storing the password. We usually use an authenticated flag to identify whether the user was successful in authenticating instead of actually storing the password. And so when each one of their users would try to access their payroll provider, we would first check, hey, has this user used this password, or sorry, used this username, which has been used by other users, and have they authenticated or not? And once that number got above a certain configurable threshold, we would basically stop the transaction. And I think the coolest part about it is that we would then relay all this information back to our customers about which user tried to use a blocklisted set of credentials. I can't share like the specific numbers for our customers, but once we launched this feature, we did start to see it in action, started to see it fire, and started to see these credentials being reused. I think it's just cool that it put Atomic in this unique position to kind of view this data and see these patterns, and then relay it back to our customers that I know that these data points are now being used in their model of fraud.
So that's it. You talked about you're verifying that sort of income and employment status, and you talked a little bit about those thresholds there. When you think about where a company can fit those into a good sort of fraud prevention program, is it only kind of at the KYC moment, or is it also, where does it fit in? Let me ask it that way.
Yeah, well, I think, specifically for the feature that I mentioned, I mean, that's kind of before any kind of transaction starts to happen. But I think, in a broader sense, our product of verifying, employment and identity, it's just extra pieces of information that is unique to a specific user that I would think, is going to be harder to fudge for any kind of fraudulent actor. Lindsay, do you have anything to add to that?
Yeah, I would say protecting consumers' data is foundational to Atomic. So not only because it's the right thing to do, but because fraudsters are getting even more sophisticated. So KYC is specifically on the docket today, but when we think about the nature of fraud getting more sophisticated, this is a way of getting into a consumer's account and taking control of their direct deposit, potentially taking out a loan with the data in the system to, be underwritten against. These are potential threat vectors that we're able to prevent against at the point of the credentialing, before someone's even gotten into the system and done something to harm a consumer. And that in advance is going to result in the financial institution not having to deal with disputes around this account is the wrong person's funding source, right? Or this is something that should have been taken out against this consumer against their wishes. So when you think about, what kind of fraud, we hope that we can prevent that. So we won't actually ever be able to measure the impact of that truly, but it's an area of top concern for us, and why we've, again, built our security framework around our consumers and being able to protect their data and giving them full disclosures to how that data is protected and what it is that they're permissioning access to.
So I want to kind of build on that a little bit, because you talk about the benefits of payroll connectivity. Can you expand on that, and also about the security benefits that come from giving individuals sort of more control? Because that's another thing that you guys are enabling.
I mean, victims of fraud in 2020 alone, if you think broadly, they incurred $3.3 billion in fees, essentially money that was taken out from their own livelihood. Today, I think that's closer to like 2.4 billion as of 2021, the first half. So like it's getting even more aggressive for end consumers to protect themselves against fraud, and identity theft is the top source of fraud according to the FTC. But in terms of like how Atomic is doing that, I'm going to take it back to Do, because again, this feature is really something that is new and novel, and something that we built out in response to the market and our customers.
Yeah, I think this feature was kind of tailored to one of our customers, but at the heart of it, it stops credential reuse. And so I think when users choose Atomic as their like centralized location to access all their payroll data, they can do so knowing that they have the benefits of additional security, because we're looking for these patterns.
Okay. And so now I want to shift here for a minute and shift over to our friends from DataSeers and talk with Adwait for a second about, first of all, tell us what a chief seer is.
Yeah.
I know, Ben, a lot of people ask me that. The concept started with the name of the company, DataSeers, right? Seeing through data. Without data, there is nothing. There is no AI, there is no machine learning. And even fraudsters use data. So the whole concept started with DataSeers. And chief seer was, everybody says, oh, I'm the founder, I'm the CEO, I'm the chairman of the board. So my job is to oversee everything. So hence the chief seer, the person that sees everything.
And let's talk about what you're seeing and what you're doing, right? I mean, DataSeers, one of the things that you do is help your clients manage the flood of data that their customers generate. So when you think about fraud and you think about building in these safeguards, what kinds of data are the starting points for that? Where are people looking in their portfolios?
Sure. So we take in two types of information, really: information about the individual and information about the transaction. When the information comes about the individual, again, there is two pieces we get. We get, the four basic items, like name, address, social, date of birth, all of that. But then we also get information about their onboarding. When they did a KYC, CIP, whether it's a consumer, whether it's a business, that data comes into us. And then all the spending patterns, right? Money in, money out, what are they doing? How are they logging into the websites? How are they logging into the mobile applications? IP addresses, phone numbers that they're dialing into IVR, and so on and so forth. And we take that information and we look for anomalies, like what Dumitru said earlier, is people using the same credentials. We have seen this happening over and over again. We see that people will use the same address. 50 people may register cards in the same apartment, and they will basically just put apartment 1, apartment 2, apartment 3, apartment 4, and so on and so forth. And they just get through because most of the systems will say, oh, that's just one unique address. Or they would use the same social. They would use social in one place, driver's license in another place, passport number in another place, and they just get through. So data is very fragmented in this industry, right? And without having data, you cannot really fight fraud. So we created this platform called Financier, again, seeing financial transactions, and we see it broadly across all of our clients. I mean, we have billions and billions of records now on the platform that we are looking at on a daily basis and making decisions. So whenever we see fragmented data that we don't know anything about, we actually have access to data sources and other pieces of information that we can fulfill the data, and we can say, okay, this is the whole picture. That's what makes us really unique and what we are trying to do when it comes to fight, whether it's identity fraud whether it's account takeovers, whether it is account opening fraud, whether it is card fraud, wire transfer fraud, tax fraud, you name it. We have seen everything on our platform.
And one of the things that you guys talk about doing is creating watch lists. And I'm wondering what makes up those watch lists? Is it individuals? Are there transaction types? Are there locations? And how do you help companies decide what should be on or off a watch list?
Absolutely. It's a very good point because, if I just want to cause trouble to somebody, I'll just go in and say, hey, Ben Jackson is on a watch list and don't give an account, right? But that means nothing. That has to be backed up by data. So a lot of what happens in that watch list is automatically derived based on what you are doing within the system. So as you know, we not only detect fraud, we have a full case management and investigation system, and then we also have SAR filings. As you go through that process, you're increasing the risk of fraud. So let's just say that somebody had a SAR filed on them. At that point, you actually have confirmed that that person or that business or whatever happened there is suspicious and that you didn't like it. That's why you reported it to law enforcement. When you got any subpoenas in to investigate about those or 314As, that's very serious information, which basically is indicative of fraud. But what happens is most of the times when people report suspicious activity, those people don't just show up on a OFAC list magically, right? It takes time and you have to do a lot more to actually show up on a global watch list and sanctions. So what we have done is, as our banking partners and our fintechs use our platform on a regular basis, and as they're using this, they're actually creating tags within the system that are hinting that this person is doing something that's not normal. Of course, we then use that data. It is across individuals, it is across devices, email addresses, phone numbers. I mean, we have access to a ton of their information to make the decision that they have now gone onto a watch list. It's a completely voluntary product. You don't have to contribute to it, but more often than not, people do contribute to it because then they can fight fraud together. And as a result of that, and again, we all know the big banks already do this, right? They have created a database of their own, but the fintechs and the smaller issuing banks, community banks, credit unions, those don't have access to the bigger tools. So that's where the DataSeers watch list comes in, where we are constantly watching, and we can stop people from onboarding if they are found on a DataSeers watch list because they, at that point, have committed fraud with another banking institution. And in general, you may not want to work with them. So that's where that concept comes in. And we use multiple layers of information because not always an individual gives you the right information. And that's how we also identify synthetic entities, stolen identities, and so on and so forth, which then kicks it into next level.
And one of the things that you've talked about, right, is taming that data demon. There's a ton of data out there. People don't always know what to do with it. When you work with clients, fintechs and banks and others, are there particular blind spots that you see where people don't realize that this kind of data is something they should really be paying attention to because it reveals something that maybe they haven't thought of?
Yeah, I mean, Ben, as you know, I've spent almost 20 years, I'm dating myself here in this industry of data. And then last 10 years, very specifically, has been in payments. And time again, what happens is when people start developing data related products, they start chopping things off. Oh, I don't need this piece of information. Oh, I don't need that piece of information. And I'm only going to use this and I'm only going to use that. And then, something happens and they try to identify what happened. And they're like, oh, we never imported that piece of information, right? So we took a completely different approach. We said, give me the raw data, give me the 8583, give me the 20022, give me the ACH files, give me the raw network files. Don't worry about what happens. Just dump them as is. It's easy for you. It's easy for me. And then when we take them in, we tag those elements. We tag that data in such a way that we can leverage those pieces. When we do find blind spots, because as we know, data in this industry is not very clean. It's not easily accessible. Where you can't just go and say, I want to identify all Walmart transactions, and here you go, voila, here's all Walmart, right? That's why companies like MX exist. So we have done our own cleaning of all of this data. But then whenever we find a hole, so the classic example is let's say order something from an online pharmacy or online company. A lot of times the merchant name is a 877 number, right? And you're like, oh, what is this? I don't know who this merchant is. So in that case, we are able to take that information and then go and figure out who that is. So we can take fragmented data and we can fully fill it in. so that there is no gaps in that data. And so what happens is those blind spots that have existed for a long time because of lack of data kind of start going away. I'm not saying you're going to be able to get rid of all the blind spots, but you're at least much, much, much better prepared when you are about to fight fraud in this case, right? So you have all of the available data elements that you can make a decision on. And that's what the auditors want these days. They're like, okay, how are you making this decision? Do you have everything you need? And if you don't have, what are you doing to get it?
And so let me pick up on that and go over to Scott here and talk about Deep Lab's approach. And you guys use a broad range of data to identify risk, including some non-traditional kinds of sources. And I'm curious about, it's kind of the same question, but in a different context, which is what is the big picture data that should inform how risk managers look at and look for fraud?
That's a great question, and thanks for having me. So I think maybe first and foremost, it's important to sort of take a step back and look at what is the business outcome we're ultimately trying to achieve, right? And from a triad perspective, ultimately it's how do you increase the number of authorizations or new customers coming into your platform? How do you decrease consumer friction? And then ultimately, how do you keep fraud either relatively level or actually decrease it, all right? And so with those business outcomes in play, Deep Labs, we really focus on really peeling back the onion and understanding this is basically a signals intelligence problem, right? How do you find signals where seemingly there are none with all this vast amount of data and noise that happens to exist out in the universe? And then actually, how do you understand the threat landscape? And so, Deep Labs, we have a very robust practice both in the public sector as well as in the private sector. And I share that mainly because fraud moves to the path of least resistance. They don't care if it's the IRS or a large, neobank or the hottest thing coming out of Silicon Valley. They move to the path of least resistance, right? And so because of that, we really do focus in on three broad categories of data to determine what signals are of use, right? I think probably the most important of those is the customer's internal data, right? We often will engage with the customer and they'll say, yeah, we're using all these third-party subscriptions and everything else. And I'm just like, that's great. Those are great vendors, great reputable data sources. But let's start step one. Let's look at your data sources. And 9 times out of 10, they're leaving, for lack of a better term, data on the floor, right? They're cutting that data out. They don't think there's any signals there. It's noise. And we're like, no, actually, this, and this, these ingredients are perfect and highly predictive, right? And in addition, you start augmenting that with your existing subscriptions to these third-party vendors, with these point solution providers, whether it be device intelligence or address verification, et cetera, et cetera. And then suddenly you start having, the means to really understand some of the predictive capabilities to determine whether or not the customer you think you're about to onboard is actually really that customer, number one. And then number two, is that the type of customer you want to onboard and to begin with, right? From a threat landscape perspective. And then Deep Labs, in terms of what we're able to bring to bear, is not only just our vantage point from having worked with both public sector and private sector, not only our scientific breakthroughs around, I'll geek out for a second, diffusing back propagation in terms of how our ability for our neural nets to learn on the fly and in real time in less than 10 milliseconds, but equally important, the ability to stitch together these signals, again, where seemingly there are none, and come out with an output and say, by the way, the person you thought, or the actor you thought you were about to onboard actually isn't even that actor. And by the way, an actor for us can be a human being, it can be a bot, it can be an organization. We're agnostic. It's basically anything that can actually create a new phenomenon or a new event. And then I can tell you a multidimensional view of that actor. And then you can determine, based on the use case you're trying to solve for, whether it be onboarding, whether it be trying to solve for false declines, again, a transaction that should have been approved but was declined, or just to eliminate fraud. And ultimately, if you start stitching together all these different signals, the data, because it will consistently change, because like any signal, it will decay. It becomes signal agnostic if you're able to, again, create a multidimensional view. And
one of the things that I wanted to bring up here is the notion of context again. And we've all lived through the past year and a half where in 2019, things looked one way. And then in the pandemic, they got turned upside down. And now we're moving into a little bit more of a confusing time. Can you talk a little bit about what that looked like as you were looking at data and you were kind of bringing some of these things in, and what did it mean when you were trying to, train those systems to look for fraud, for example, when everybody's behavior changed so rapidly?
It's an excellent question. And I would say I'll actually go back a few more years before 2019, right? So, for the payments folks that are on the phone, you guys might recall that certainly in Asia and certainly in Europe, Western Europe, the EMV chip has been around for, over a decade at this point, but it wasn't mandated in North America to 2015. And, I mentioned that in terms of the year 2015, because that was a big year as it relates to card not present fraud. And the reason being is the EMV chip was basically designed to decrease point of sale fraud, right? And like I mentioned before, fraud moves to the path of least resistance. And so online, the EMV chip is irrelevant, effectively, right? So 2015 comes, there's reterminalization, the liability shifts, for lack of a better term, and then fraud moves to the card not present channel. You fast forward to 2019, all right? All the risk practitioners have done their jobs, right? They've hardened their systems as it relates to, the card not present fraud, are doing their best, right? And unfortunately, in 2020, the pandemic hits. And keep in mind how risk systems traditionally are built. They're built off of long-term profiles, building up who Scott Edington is for the last 15 years as he's gotten older, right? They're built on short-term profiles. What has Scott done in the last 30, 60, 90, right? But guess what? Scott Edington in January 2020 was remarkably different than April 2020, all right? Sitting in San Francisco, shelter in place, whatever they wanted to call it at that point in time. My purchase behaviors, all of our behaviors were dramatically different, right? So from an identity standpoint, you looking at me, you say, oh, that's clearly Scott. He speaks the same way, he acts the same way, but my persona has shifted. It's shifted based on a number of factors: space, time, social construct, the fact that everyone's scared, because they don't know what's going on in the world. And thus our behaviors have all shifted. And so those same traditional risk systems, those same traditional data sources, all of those signals, for lack of a better term, they decayed overnight. And so if you're a merchant or you're an issuer, you have two choices. You can decline all the transactions, easy fix, right? But my guess is you're probably gonna get a call from your CEO. Or B, you let everyone in, you let everyone on your platform and you approve all transactions and you get killed with fraud, or you have all these account takeover issues, right? And so again, it goes back to that triad I mentioned before. It's like, how do we increase payment authorizations, onboarding, successful onboarding with customers you want to have from an LTV perspective? How do you decrease consumer friction? Because again, you don't want to lose top of wallet status if you're an issuer, right? Studies have shown that if you lose top of wallet status 80% of the time, you're not getting it back. And then, ultimately, I don't want to get a call from the board or from, my chief risk officer. So how do I keep fraud level, right? And so I mentioned all I would say as a backdrop, because ultimately you have to have a system in place that allows for the differentiation or multidimensional view of various actors in real time as the advanced persistent threat landscape continues to shift, because it will, as we go in and out of variants and all that fun stuff. You have to be able to keep up with the bad actors. And to be very clear, these bad actors are not the bad actors of yesteryear, where it was basically only nation states or script kiddies sitting in their basement. These are well-funded syndicates. These are folks who, in some cases, used to be actual risk practitioners. And because of the democratization of compute power, all you need really is a credit card. Most of the time it's going to be stolen anyway. Set up a presence on a GCP or an AWS, and then suddenly you're able to do very nefarious things.
So I want to go back to something that you mentioned, and I didn't get the exact phrase, but essentially you were talking a little bit about identifying good transactions as well as bad ones, and how important is it to do that, number one, and number two, are there ways to sort of identify, and I think about this in terms of even my own personal shopping, right? Obviously I have a profile based on who I am, but if I buy a Christmas gift for my sister, that product, that transaction might look very, very different from my pattern, right? And so how important is it to be able to identify that is a good transaction? And then how hard is it to identify that is a good transaction?
No, that's a great question. And so the term that I used, and certainly a lot of payments folks, at least on the card world, would use, is a false decline. Again, that's a transaction that should have been approved but was declined. And the example I always use for folks who maybe haven't had this happen to them is, you land in a city you've never been to or haven't been into in 10 years. You take a customer out to a very nice dinner, basically at a price point you typically wouldn't buy for yourself, right? And the bill comes, you try to pay for it, and you get the whisper from the waiter, like, "Sir, sorry, like, your card's been declined." And everyone's embarrassed, right? And so that teaches you not to use that card in that scenario ever again, right? I can tell you the issuers, they hate false declines for a number of reasons, to include you lose the top of wallet status, you introduce consumer friction, and oh, by the way, they've lost the economics of that transaction, right? And so to dimension how big of a problem it's been and how it continues to just be further exacerbated with all the trends we just finished talking about, in 2017, false declines were roughly $180 billion. Big, ridiculous number. Actual fraud was only 24 billion. So get your head around that for a second. Most people are actually focused on the wrong war, right? They're focused on, oh, wait, I can drive out fraud. Well, yeah, of course you can. Just unplug everything, right? But again, you're going to get a call from your CEO. 2020, 2021, you're looking at false decline figures of well north of 400 billion. Think about the economics, all right? And so to answer your direct question, Ben, how do you sort of solve for that problem? It's a bit of both art and science. It is about understanding the threat landscape. It is about understanding patterns. It is about understanding which predictive signals you have to use and stitch together in real time to understand that, no, it is Ben. And yes, he's shopping for Christmas a little bit earlier, but it is Ben. And we definitely don't want to turn that transaction down. They will be very upset with us, right? We've had Ben as a customer for 20 years. The LTV of value of Ben being around as he's, kids going to college, mortgage, retirement accounts, blah, blah, blah. We want to keep Ben, right? And so, I guess pulling this all together, ultimately it is about understanding both the old school way of doing things, stitching together the long-term profiles, the short-term profiles, having rules in place, the velocity checks that some of my colleagues here also talked about, very, very important, extremely important, frankly, right? You can actually take down an awful lot of fraud just from putting in some of those sort of basic checks in, right? The address verification, absolutely, but it is very, very important to also introduce some layer of context. It's essential.
So I want to throw that question open to the rest of the panel. And let me just pause here before I do that and say, we have the Q&A section at the bottom, and I certainly encourage our audience to put in questions, and we have the chat if folks have any other observations that they want to make. And our panel is here to take questions, certainly that you might be facing. But to the rest of the panel, if you guys could pick up on where Scott left off about identifying good transactions, identifying good actors, do you guys have thoughts about how that goes?
Yeah, it's Ben, we see this in the industry, in the international space. There are some companies that do it here too. For example, my American Express card, anytime it sees a atypical transaction, it'll actually send me a safe key. It'll say, hey, I don't want to decline this. I just want to confirm that it is you. And they have done a pretty good job of that, right? Because, like 2 days ago, I'm here in Vegas and I'm swiping my card in person, so they know I'm in Vegas. And then, people in our office were working late, so I ordered pizza online and have it shipped to, the office address. And they immediately said, whoa, what's going on here, right? But instead of declining, they actually redirected me to hey, please verify this transaction because we are seeing something odd. So Amex does this very well. In the international space, this also happens quite a lot. I haven't seen this happen too much in the US when it comes to Visa cards and MasterCards. I mean, it may be in use, but that's one way of potentially looking at reducing those false declines.
And with Atomic, do you guys find that, because this came up, I was thinking about this when you were talking about reuse of credentials, for example, and if somebody is a job hopper or a temp worker or something like that, how are you guys identifying those kinds of things when you start to see either changes in income or changes in employment, that sort of thing?
At the heart of what Do built is, this idea that someone is trying to break into an account or use credentials to hop around. So that in and of itself is the way of preventing and identifying this pattern. I'm going to toss it back to him to see if he wanted to complement that in terms of, what types of opportunities there are to sort of identify good transactions, bad transactions. But in this sense, it's, this is an authorized access to the payroll account versus, say, an unauthorized one.
Yeah, we do have specifically talking to the feature that was built out, that use case where a user does go from job to job. We do have some knobs that we turn, which changes the threshold of when this fraud fires. One of it is being, how many times have we seen these credentials being reused? Another one is like a time window of like how many times were these credentials reused in this specific window. And by just configuring those, we can kind of fine tune it to, whichever, what our customer wants. Hopefully minimizing those kind of transactions.
So I've got a question here from the audience that since the start of the pandemic, which new signals have emerged as predictive and which ones have kind of become less predictive, less useful?
I'm happy to jump in if that's okay, Ben.
Sure.
Sure. So let's start us off. So I think there's a couple of things, right? So beyond, it's gonna be a very long answer to your short question, but the difficulty for a lot of risk practitioners right now is that some of the point solution provider signals, let's say from the device intelligence vendors, a lot of those have become, at least their life cycle has become shortened. And part of that's because of the lockdown associated from Apple and from Google and Android in terms of what signals can actually be pulled off of these devices. All right. Whereas 3 years ago, those signals would actually have a high confidence level for 180 days. You're now talking about windows of hours, if not minutes. That coupled with what's happening with, again, some of the advances in the browser technology, where again, some of the tricks around cookies and other things have been limited, right? And so with that as a backdrop, in terms of new signals that are emerging that are becoming or are at least equally as predictive as some of the device intelligence vendors, I mean, it really comes down to behavior. All right. And so, my colleagues here on this panel, I think have done a great job talking about the different types of behavior, whether it be velocity, whether it be, people, typing in certain keystrokes, or again, using the same home address, but with 20 different apartments in a single family home. Oftentimes it comes down to taking a step back and just doing a logic tree, right? And building those logic trees into new rules based off of the fact that most people are now, I shouldn't say most, a majority of folks who used to have to go into the office no longer, they work from home. And so understanding that as a backdrop from a behavior standpoint would dictate that, of course, Scott Edington will be spending more time shopping on certain websites at 4 o'clock in the afternoon, as opposed to 2 years ago. Of course, he wouldn't be at home because he'd still be in the office about to start his commute. All right. So it's that sort of basic logic tree coupled with the fact you have to now decrement the confidence level associated with the dynamic signals of 2019 is something I think is very, very important for a risk practitioner to understand.
And to tap on to what Scott said, right? One of the things which has become very important past pandemic is identity, right? Digital identity. Everything went digital and people started propagating fraud the other ways. So like Scott said earlier, in 2015, after EMV, fraud goes online, we get it perfected. Here comes the pandemic, things start getting messed up. People were reacting still. They were doing a lot, as much as they could, right? Because at that point, they had all the models ready and they just had to, turn some knobs. So what happened and what we saw was that fraud then quickly moved away from card and completely went over to PPP and stimulus payments and unemployment fraud. And those channels were completely unmonitored. People didn't have a very good fraud detection system in the ACH rails that say, hey, wait, this guy's getting unemployment from 3 different, states at the same time, right? And so the challenge becomes that you have to keep your eyes open. Unfortunately, there is nobody in the world that can say that, I'm going to stay ahead of fraud, because you can't. You're always behind fraud. And the ones that win that are very close, right? The idea is to close the gap as much as you can. If anybody out there thinks that you can get ahead of it, Unfortunately, the fraudsters only have to be right once, and the people who are fighting fraud have to be right every single time. So that math just does not add up. You're going to fail at some point of time and they're going to win. So what we learned more so that what features became relevant and what features did not become relevant is it changed our mindset as data scientists. It's changed our mindset as companies who are fighting fraud that wait, we got to think in every direction. We got to have a different approach now and all of that. So that kind of helped tremendously to be prepared, a little bit better. We will never be completely prepared for what's about to come.
I'd like to add on to that. When you talked about unemployment systems, it sort of hits home for us because we built out connectivity to unemployment systems as a result of seeing consumers going through the atomic flow, trying to look for their unemployment benefits. So in terms of what signals are and are not predictive anymore, I would say employment status and potentially income, because during the pandemic, for some, the unemployment benefit was higher than their own, initial salary that they lost. So you've got all of this data that you're now going to have to build into it if you were a lender in the underwriting, that anomalous period of that person's time where they were unemployed as a result of, a global pandemic, not because they, were not employable, but it was just one of the largest, periods of unemployment since an earlier depression. So for those indicators to be used in that particular instance, I think it's going to be less predictive of if that consumer can or cannot pay back that loan, which is why we've started to build out features and services to go to the point of payroll and say, if you have a paycheck and you'd like to start to pay that loan back from the paycheck, then that is a higher indication of willingness to repay that loan, which then benefits the lender to give them the loan to begin with and offer potentially a lower interest rate that's not egregious because maybe their credit history is no longer as perfect as it used to be. And I think that the trend of how people work is certainly going to stay with us, such that they could have multiple jobs and want to work in different gig economy styles. Like we've built out the ability to connect Uber, Lyft, and a bunch of other gig economy platforms so that you can create a record for that end consumer and create a consistent, income for them and a status around if they are or are not employed. Just because they're not doing a gig on Uber and for like 6 months does not mean that they're not doing it for Upwork or for Lyft or somewhere else. So the nature of work has fully evolved. So you can no longer rely on, the traditional like biweekly, weekly pay cycle to indicate if that consumer is in fact who they say they are. They might just be gigging on another platform for a couple months. I wanted to just highlight also, did you have anything to add to that?
No.
He built most of the features, so I just get the pleasure of talking about them broadly, but he can get into the weeds if we wanted to like unpack it a little bit further.
Well, I wanted to talk for a second because you guys are all working with this data and with the flood of data. And there are a lot of terms out there. There's AI, artificial intelligence, and machine learning. There's predictive modeling, all of these kinds of things. Can you each in turn kind of talk about what sort of tools you're using to manage this data that you guys are seeing?
I'm using Do. No, just kidding. But I will let him take the more technical side of this because he definitely owns this space.
We do have our machine learning department. A lot of the trends that we see are simple enough that don't need a big neural network to solve those problems. And we do the iterative approach a lot. So the simplest model, and as we see things become more complex, make our model more complex, eventually reaching into the machine learning models. But yeah, that's it.
Sure. So Ben, we use a very large, of course, big data system. We have multiple models that run, and we use what we use. It's open. We have been very vocal about what we use. It's HPC systems. That's what LexisNexis is completely built on. It's a 20-plus-year-old technology, and it allows us to do machine learning at scale, where traditional systems like Python and Spark are slower. HPC systems allows us to actually harness that data at a much faster capacity, because for us, it's all about speed and accuracy and then volume of the data. But we have our own machine learning department. We have our own data cleansing, third-party data sourcing. So it's all goes in that.
Yeah, and I would just echo his last comments. You know, we certainly have a dedicated, in our certainly opinion, in our customers' opinion, world-class data scientists, you know, and certainly modelers. But I think equally important is the data orchestration layer, and all of our engineers, they're actually building the pipes to make it easier for us to pull and push the data via APIs to our customers, because again, a lot of our use cases deal with real-time decisioning. And again, to be very clear, real-time for us is less than 15 milliseconds, right? Near real time is 250 milliseconds, you know, and then batch, for lack of a term, is a second or two, right? As opposed to the traditional 2 days or 1 day, right? And so I think it's the layered approach. And again, AI is very, very important. Like clearly we're an AI company, but I think sometimes that the term is used very loosely for a lot of people. And ultimately, if anyone says, yeah, it's strictly AI, I always sort of like, ooh, that's an interesting answer, because typically it's a combination of AI, machine learning, deep learning, which again, are subsets, rules, and oh, by the way, we have some models. All right, there's no sort of one size fits all. It has to be a stack.
And when
I was just going to say onto the data orchestration layer, which is something that we provide as a payroll connectivity provider. The way that we've built our integrations is by reverse engineering APIs. We don't try to go about the screen scraping methodology as a result of data reliability, because that's something we've heard about within financial services, heard some aggregators mentioned on this podcast. But I think that the ability to connect in with APIs that are more secure, and they enable speed, and they don't, you know, overload a payroll system, that's ultimately going to be a benefit for anybody. So really appreciate Scott's comment around, like, you know, building the infrastructure right from the ground up is incredibly important, because it does impact, you know, how you partner in this spaces.
And as you guys bring these tools into the environments, right? You're connecting, you have to connect with banks, you have to connect with fintechs, you may have to connect with their third-party processors. How difficult is it to layer this on? What is the implementation challenge for bringing your system into what could already be a fairly complex value chain?
I mean, from an integration standpoint, I'll just take it really quickly. We've seen someone get up and running in 4 hours in our sandbox environment, just no customizations with our SDK. So we can get you up and running quite quickly. As you mentioned, the things that take the time are the procurement processes. But thankfully, a lot of neobanks that we work with use similar banks. So we've been through the procurement process, and it is a more streamlined approach for us to be able to be approved. But we operate like we are somewhat a financially regulated institution, in that we process PII all on site in Salt Lake City in our headquarters. We have, you know, security audits on a regular basis. We maintain SOC 2 type 1 and type 2 compliance. Like, that is foundational to the space, because we understand how important it is to build consumers' trust at the end of the day. Like, if we want them to build this new behavior of logging into a payroll system on a, you know, in a financial app versus going over to HR physically, which they can no longer do, like, we need to make sure that they understand how they are being protected and what it is that we are and are not doing with their data.
Yeah, and I would echo that. So certainly we have the, you know, the SOC 2 PCI, all the fun acronym bingo in terms of certifications. You have to have it. You know, I think
It should be table stakes, right?
Yeah, absolutely. And so certainly Deep Labs has it. I guess what I would focus in on is that the integration, that's actually not the hard part. And it sounds weird to say it's not the hard part, but it is. It's about the data, oftentimes the data normalization, right? And so part of the challenge is, you know, we'll arrive, you know, virtually on site, for lack of a better term. And it's like, yeah, we want to do this. We want to make sure we get, you know, lifts and, you know, with regards to false declines and fraud, like, awesome. Yeah, we can do it. You know, we're typically in 2 days, we can show value, you know, that sort of thing. And it's like, all right, let's plug in the data warehouse. And it's, right. And so my point in sharing it with you is that this is actually a normal thing, right? And so we often say we build that into our contracts, where we like, look, for the first 30 days, realistically, I know we can show value, but we actually, let's take a step back. What are you trying to achieve? What data you have access to? How clean is that data? And by the way, if it's not clean, we've been here before, we can help you. But let's focus on what is clean, because we might be able to show it some immediate lift, especially if you've been hit with some of these bad threat actors. We can immediately help you. But long term, for the next 12 months, here's what the program has to look like. And then here's what the outcome, the business outcome you can expect by having this normalization of data.
And going off of what Scott said, it's important, right? We work with banks. So of course, SOC 2, PCI, all of that is necessary. We go a little bit more because we are now FFIEC I mean, the vendor due diligence questionnaires are like, 6, 7, 10 pages deep, and they're constantly coming in. That actually takes more time sometimes than an actual implementation, because we are connected to pretty much every data source that's out there, all processors, all different types of data. The challenge becomes is when people want to start with us. I mean, we're going through this right now, right? We have people who want to sign up with us, and their legal is actually looking at the contracts, but the business wants to go live in 30 days, and the contract is not even signed. And so we deal with that a lot these days. It's like, okay, we can get you up and running, provided you can sign the contract, right? And sometimes people are putting cart before the horse and trying to get there. But Scott is right that you have to have your 90-day goal, 6-month goal, and 1-year goal. It's not going to be all perfect on day one, right? But can it solve majority of your problems? Does it get 80% there? And the last 20%, we can keep on chipping at it, until we get there.
So as you guys look at all of this data and you're seeing all of these things about people's lives, what would you say to people who are concerned about privacy in this context? Because obviously we're seeing sort of more discussion of it in the popular context. And as that happens, obviously California is the leader, Colorado, and I believe Virginia are considering privacy and data management laws, those kinds of things. What kinds of things do you guys need to do in order to manage those privacy concerns?
Yeah, I can take that, because we are probably on the worst end of the spectrum, because we need to have all raw information. Because when you're filing a suspicious activity report, you got to have the person's name, the person's SSN, the person's details, because without that, so we can't just say, oh, we one-way hash it and we don't have to worry about anything, right? So being on the worst end of the spectrum, the challenge becomes what is required under some of these regulations that are out there, right? Because yes, GDPR, CCPA, they can come up with all of these regulations, but at the end of the day, you cannot commit fraud on the system and just come and say, hey, delete my information. That's great, right? I'll keep doing this again and again. So you can't. There are laws that supersede any of those that say, if you have transacted with me financially, I could get a subpoena, and I have to serve that subpoena as a part of doing business, right? So privacy is very interesting. It's shifting, so at one end, I tell people that if you want privacy, just like Scott said earlier, unplug. Don't post anything out there. People are actually posting more stupid stuff on their social media accounts than anything in their financial services accounts, right? So my point is, okay, I know you spent money at Starbucks, but you actually posted that on Facebook, right? So everybody knows that. At least I'm the only person that knows this part. So it's very touchy-feely. People talk about privacy a lot, but I don't think everybody really understands privacy, because when it comes to payments, there's a different way you have to look at it, and when it comes to everything else, you have to look at it differently.
Yeah, I think that's you saw a lot of my head nodding. It's spot on, right? And what I often say to my friends who aren't in this industry is like, Scott, what do you think about privacy? About et cetera, et cetera. I was like, you're actually your own worst enemy. Your behavior, the stuff you post, the stuff your kids post, like that's how the bad people will go after you. They're not hacking the major banks, right? That's not how they're getting at you, right? And so my point, you mentioned that is, the practitioners that we deal with, the risk practitioners that we deal with, they're highly conscious about privacy. They're very, very worried about it, and they do care about consumer privacy. They absolutely do. The cool thing is, you mentioned one-way hashes. There are a number of breakthrough technologies that's been sort of in the research labs for the last 20 years at DARPA and IBM and places like that are now coming into full production because of the advent of quantum computing, because of things like homomorphic encryption. These are all things that maybe not in 2021, but certainly 2023, 24, et cetera, that will allow for some privacy preserving data elements to be used that are highly personalized, hyper-personalized, but it won't allow an external actor to come in and still take those PAI or PII data. So it's actually, cliche to say, but what a time to be alive right now, right?
And I will say also at Atomic regarding PII, for all the data that we do get, most of it is transient. So any of the credentials that are stored, they're usually only for a day or two. They give us the key, we see if it works, and they kind of throw it away, whether it does or doesn't. We also do have functionality built in for any user wishing to, remove all their PII. They can do so with a click of a button. Again, central back to Atomic's mission is to provide that like secure location to access all your payroll data. And we try to just build upon, again, layers of security around their information.
So we have a few minutes left. I can talk for a long time, obviously, but I want to make sure, do we have any unresolved questions or other questions from the audience before we wrap up? We'll give folks just a minute. I want to say too, I am proud to say that all of the companies here are members of the IPA. So certainly if you guys want to reach them afterwards, feel free to reach out to me. I'm happy to help foster that connection. And somebody did ask, how do we contact you to learn more? So easiest way, of course, is if you want to go through me, it's bjackson@ipa.org. And then we will have contact information available for the companies. We'll link to their websites as when we post the video.
You can share my PII. I'm okay with it. I give consent.
There you go. That's all I need, right? As long as the user consents, I'm in the clear. Okay, well, great. Thank you guys all very much. It's been a great discussion. I appreciate you all taking the time. And as I say, there'll be a recording of this if anyone has colleagues that they want to share it with. And if there's anything else that we can do for all of you, our members, and fostering these connections and helping you resolve your problems, please reach out and make sure to check out our podcast, subscribe to that, follow us on Twitter and on LinkedIn, and follow all of these companies as well. And thank you all for attending today.
Thank you for having us.
Thank you.